Hi everyone, my name is Vess Rusev and this is episode 38 of the East Auckland Property Show. And today we're going to discuss finance and mortgages with Daniel Lipman from Mortgage HQ. Okay, it's the new name, previously known RFI, so I'm just struggling with the new name, Mortgage HQ. Hey Dan, how are you going?
Hey, Vess, very well, thanks. Thanks for having me on the show. I've always watched all the episodes, and you've had some very notable members on the show before. Simeon Brown, local MP, and of course, older brother and mentor Brandon Lipman. So
Yes,
really happy to be here.
awesome, and good to see that you're at the Half Moon Bay Marina.
Yeah. I thought since most of the episodes for the finance side take place here at Half Moon Bay, I didn't want to let the lockdown get in the way of that, so just chuck the. I'm actually just here in my bedroom.
That's really cool. So
yeah,
you've rebranded the name. So you used to be RFI, now you're Mortgage HQ. It sounds much better, I would say. And why?
Thanks, mate.
Why did you do the whole change rebranding? What was the reason?
Yeah, so we made the change. Obviously, the company's a few years old, and since we're coming on 5 years now, and since I joined 4 years ago, there's been a lot of new faces and a lot of changes.
Yes.
So in terms of the company going in a different direction of what we're really about, one being extremely focused on giving impartial advice to all our clients, and just making sure they get the best financial solutions that are available. So we wanted just to make sure that we're restarting everything and that the message is very clear, and just give ourselves an opportunity for a new chapter with so it's the exact same staff as before when we were RFI, so nothing's really changed. It's business as usual, but we've changed it. Like you said, I also think the name's a bit better. And it's a bit of a nicer, cleaner look.
Headquarters, mortgage headquarters, or what's the
mortgage headquarters. Yeah.
Oh, that's really cool. So did you change I suppose you changed your working routine, so you're probably working from home and do most of the stuff from home now?
Yes. So I suppose business as usual with the banks and clients here from home. I'm here in my house. I got 4 other flatmates here as well.
Yes.
I'm in my bedroom because my living room is a bit of a call center where we usually work from. So I've just navigated to my bedroom here, and or should I say Half Moon Bay? But we're business as usual. So I suppose exact same things: managing clients, getting approvals, and obviously, like we mentioned before when we were off there, a lot more FaceTime with our existing clients than we usually would. We may have been facing some changes in this tough time.
Okay. So let's start from the global markets, and then we're gonna narrow down to New Zealand. What is your understanding how the global market's being affected by the pandemic so far? Financial market, we're talking.
Yeah, I suppose financial markets. I can see obviously there's a lot of talk on what's happening across in the big markets. The American markets, S&P 500. A lot of companies are taking a lot of hits. Velocity of money's slowed right down. No one's making as much revenue as they used to. And obviously just speculation about what's happening is causing a lot of downward pressure on the financial markets. And I suppose on more of a different level, unemployment rates are going back towards where they were at GFC 2008 time. So just those two things combined have got people feeling really worried on a global scale, which I think is probably what we're going to see for the next quite a few months coming through, depending on what happens. I mean, obviously, what you can see in New Zealand, not trying to fast forward here, but we've done a bit of a stellar job in terms of getting as much control of the situation as possible financially as well. I think the stimulus package that the government's put in place is world class. Obviously, will need to be reviewed in a couple of weeks, but is still world class. And I mean, seeing a lot of those coming through with different economies globally is good. So I suppose making the best of a bad situation. Yes, there's a lot of pressure on the financial markets, a lot of downward pressure, and a lot of companies are in trouble. But hopefully, we'll have to see what happens in the next 6 months on a global scale.
how the whole influence from the global markets, it's affecting the local banks or the local financial market in general.
Yes, yeah. So important to mention, obviously, what we discussed before. I'm, specifically a financial advisor, mortgage broker. So don't take any of my
yes,
my points on the global market seriously. It's just my personal opinions.
Yes.
But yeah. So something I'm obviously very clued up in would be the New Zealand, situation with the banks, and I suppose the first things first, massive interest rate cut straight when this thing was taking off a couple of weeks ago. OCR dropped the lowest it's ever been and the biggest cut it's ever had. Obviously, that's the official cash rate, the biggest influence of our interest rates, and that happened straight away. Just the Reserve Bank saying, "Look, we're going into some tough times here. We need to make sure when we get out of this that we're doing whatever we can to stimulate this economy." And that starts with cost of borrowing, making that very accessible, credit accessible for businesses and obviously residential homeowners. So we want to make sure once this all is over, our small businesses and also, our big corporates have access to cash. And so we can start stimulating that economy again, because velocity money's just slowed right down.
So how many points did they drop the OCR?
I think it was 0.5. So it's down to 0.25, biggest cut. Wow. And yeah, it just happened pretty much just before I think we went to level 3, dropped it straight down. So interest rates specials 3.05, lowest that we've seen ever.
3.05. Wow.
Yeah, that's the special advertised rates at the moment. Yep. And I think very, very interesting time for first home buyers. And all investors and people who do have mortgages. It really can go either way in terms of the markets looking forward. I think it's been suggested heavily by economists that we're going to have low interest rates for at least 12 months, 24 months. So best case scenario, we come out of this happy days and it's going to be a lot of opportunity for people to get into the market at a very low cost of borrowing, or the market stays slow for a bit and that drags on for the months to come. So we really don't know how it's going to end up, but on the bank side of things, very, very low cost of borrowing, which is obviously great for existing mortgage holders and alleviates some pressure in terms of cash flow for mortgages.
And how easy is the borrowing process now? Is there any difference during lockdown and prior?
Yeah, great question. The biggest difference is the banks just being a bit more delicate and asking a few more questions about the client's existing situation. So for those existing approvals that we did have, some of those clients who are now wanting to move through the process and they've found a property even in lockdown or just before lockdown, they found a place and they want to progress that. The bank is just asking, hey, how has their situation been affected by COVID-19? What is their, what industry are they in? Are they in industries that have been heavily affected? Do they work in tourism? Do they work in New Zealand? Yeah, these sorts of things. And if, lucky enough, majority of my clients in this situation haven't been, although there are a select few that have been heavily affected, are able to continue to proceed through the process. But that's just the number one question that when we're making new applications to the bank at the moment, they stop you at the door and they say, look, how are these clients being affected by COVID-19? Can you please explain, give us a narrative? How secure is their income? And do we have reason to believe that if the lockdown goes on for longer, that they're going to be in financial strife?
So are the previous approvals still valid? I mean, for the 90 days that they usually issue them, or?
Yes, yeah. Well, they're still valid, but obviously, these documents come with a bit of fine print. Yeah. And the fine print states if situations change, we have the right to withdraw their approval. So that would cover the banks in terms of if both clients lost their income. So we have heard some horror stories of clients who have just gone unconditional on a property prior to lockdown, and then are now in a situation where they've lost their jobs. And that specific scenario, that one came to fruition, the banks did tend to help out in the client's time of need because it's a really strong client profile. But there are those sort of risks and those sort of situations that are happening because now clients have, been put in a really tough situation where maybe there's been loss of income, and they're nearing unconditional on a contract.
So it takes. Would you say it takes a little bit longer for the approvals?
Well, as you can imagine, the demand for lending has slowed right down in New Zealand. I don't think it's the same in Australia. I think Australia is still writing a lot of new lending, but for us, it's really slowed right down, because some of the banks are saying, look, we're going to close our doors on refinances, and we're only going to help our existing clients for new purchases until this whole thing blows over, which is completely understandable in terms of not wanting to take on too much risk. So that's really dropped back the amount of new applications. So it means that there is a bit more free flow in terms of getting approvals through. But on the other side, the banks are now kind of inundated with these requests for hardship or a bit of alleviation on repayments. So they're still extremely busy, but on the new purchase front, there's a bit more free flow.
So if someone is putting a conditional offer with finance condition, do they need to factor that in and just put, instead of 7 working days or 10 working days, to put a little bit more time? You think
yes, I'd definitely say so. I mean, probably if anyone's making a conditional offer in this market, they're putting a big fat condition clause, or finance stage, at least probably 15, 20 days, because I can't imagine, or there's some lawyers that are still very active, but you want some face time with your lawyer to really look over the document, look over the title, and make sure there's no defects or anything like that.
And yesterday I did an interview with Christine King, with the lawyer Christine King from Duncan King Law. I will link in the description below, because she just gave very good advice relating to all the conditions and settlements and everything that is legally property related. And you mentioned hardship. Can you please tell a little bit more about the mortgage holidays and how the banks are coming to play in helping people who are in need at the moment?
Yeah, great question.
Struggling with repaying their mortgages?
Yeah. So as you can imagine, there's a lot of people out there who are experiencing some loss of income. More commonly just decreased hours, or put in a position where not as much money is coming in as was previously prior to lockdown. So the banks have kind of made it a lot more accessible, these processes, which used to be quite tedious to get through, for mortgage holidays, interest only requests, that sort of thing. They've made it a lot more streamlined and a lot more accessible for those clients who are struggling. I think something like 68,000, I read yesterday, 68,000 mortgage holders in New Zealand have requested for some relief.
68
for them all. 68,000, have requested for some sort of relief. So there's 3 ways which a client can get relief for this hardship. The first and most ideal situation would be reducing the mortgage term. So say, for example, you bought your house 8 years ago, you were on a 30-year loan term, and now you're on a 22-year loan term, just reducing that right back out to a 30-year term. Because that way, obviously, you're still making a reduction on the principal, but at the same time, you actually, you're still reducing the principal. You're not deferring any of the interest and any of that nasty stuff that comes with having to do that. But it's not the end of the world.
So reduce the principal by increasing the mortgage term, right?
Yeah, increasing it. So taking it up to 30 years again. You've got it down to 22, back to 30 years. Obviously not ideal, but at the end of the lockdown, or when your income returns to normal, you can bring that right back down to 22, and you've still managed to make some payments towards the principal during that time. So that's obviously the ideal situation. Some clients won't have that luxury and won't have as much cash flow available to do that. And then secondarily would suggest interest only. So say, for example, if one income's been lost or put on hold, one person's been made redundant, one person is no longer working for the time being, then just do that test and see if you can make that interest only repayment, removing the principal portion of the payment, and saying, hey, can we manage this on our cash budget just with interest only? that's the most important thing to figure out, because that's what we're telling our clients is just cash flow. Don't get stressed out about the big picture. Just think now, what do you need to get through this time in terms of cash flow? What's going to make you guys get through this okay and feel really comfortable? And it's different for each scenario. So I'd say, just most of those ones, if one income's lost and you can still meet your payments interest only, that's the next option, interest only. And then I think the biggest one, number 3, the biggest one that you've seen in the news the most would be the mortgage holiday. Everyone's talking about that, and it's quite a topical product. And I think, obviously, going right back to the start of my career, just the term mortgage holiday is extremely misleading, or gives off the wrong impression in terms of what the product actually is. Because it is a holiday from the repayments, but not from the interest. It's the correct term is actually a mortgage deferral. So, for example, if you have a mortgage of, say, 600K, and during the time of 6 months you take a mortgage holiday, during that 6 months, you don't pay anything, right? But all the interest that you would have paid gets accrued, it gets put together and then capitalized at the end of the loan. So you'd be paying something after 6 months. You'd be paying something like 600. Your mortgage would be 612,000 rather than 600K. So it's not a holiday. It's a very incorrect term. It's more of a deferral, and you will have to pay that later on. And so, for clients who have a bit of equity, it's not the biggest deal if they you lose both your incomes, or you lose one really important income. And you need that cash flow. Mortgage holiday is not the biggest deal, because you're going to add a bit more time to the mortgage, but look, you've got a good equity position, so it's fine. Or just the most important thing is just to get through the time period. So that's when I recommend the product, is when you look at the interest only payments and you say, look, I can't afford this. I actually need the mortgage holiday. And then you'd say yes, because you can get that on a 3-month basis, and then you get the 12-week holiday, and then in a perfect world, things are back to normal in 6 to 12 weeks, and then we're hunky dory, you beauty, just business as usual. But we'll have to see what happens. So it's that would be a recommendation if you're in a situation where we're telling clients, look, if you can't afford these repayments, even on interest only, and you're just feeling a lot of strain on your cash flow, and you don't want to start having to dig into the emergency fund or however you got your financial set up, then would suggest that product.
So there are 3 different options, right? So the first one, which is probably the best one, is the extending of the mortgage term to reduce the mortgage, the weekly or the fortnightly payment. The second one is interest only, and the third one is the break, which is actually the holiday. It's not a holiday; it's more mortgage deferral, right?
That's right. And I think with that last product, that you see a lot in the media, people saying, "Oh, look, mortgage holders are getting mortgage holidays. So why don't tenants get rent holidays?" And I think giving your tenants a bit of alleviation during that time is important. If you have the cash flow to do that, but you don't want tenants to be in a situation where they've got a misunderstanding of the situation and they think that their landlord is getting a free ride when it's not the case. So just to make sure we don't want any animosity between the two parties. And it's important that the tenants understand as well as the mortgage holders that it's not actually a holiday. The client's going to have to pay for this eventually.
And do you know what's the proportion of the different options the banks are dealing with? Are there most of the people going for the holidays, or most of the people interest only? Do you have an idea? Or
well, I think that a lot of our clients, we definitely recommend them down the interest only path. Because we say, look, let's look at your finances. Let's lift up the hood and see what the cash flow is looking like. We give them the figure. If it's a 500K mortgage, can you meet this fortnightly repayment? And they say, yep, we can make that. No worries, let's do that. But I think clients who maybe just go direct to bank and don't get the right advice, they may just wander into the mortgage holiday because it's a bit of an easier option. without getting the right advice. And for some people, it's the best option. For some people, it's the best option. But it's really important just to get impartial advice around that before you go ahead and sign up to it, and just figure out if you actually can, meet the repayments. That's the biggest thing.
So are the banks charging any fees for restructuring your mortgage?
It does depend. So if you're breaking the fixed contract in any scenario, you are going to be paying a fee for that. So for example, if you're on a 3.5% interest rate and you want to break onto a 3.05, you're going to pay the break cost, which is going to make the changeover. It's going to cancel it out essentially, the break cost. So you are going to have to pay that. But say if you're just going on to interest only on an existing fixed term contract, you're not going to have to pay a application fee. The banks aren't going to charge you application.
Is it the same for the mortgage holiday?
Yes, yeah, it's the same for the mortgage holiday. Yeah.
Okay, that's good. That's good to know. So people don't have to pay additional fees, especially in a time of hardship.
Yeah, that's right.
Yeah, probably people are also thinking of if you have a big mortgage or you have a larger borrowing, how to restructure, because sometimes you're going to pay the penalty or the fee. But if there is a huge difference between your interest rates when you borrowed and the interest rate right now, probably it's worth it for some people to do it, right?
Yeah, definitely. It's always worthwhile reviewing your situation and seeing if you can make some savings, because the break fees are changing all the time. So always have a sit down and say, look, maybe up front you're not going to make the biggest savings, but you can always look to add that onto the loan and then make some longer term savings by getting on the lower interest rate and improving your cash flow. So it's always good to review and see if you can do that.
And Daniel, before we wrap up, just a last question that might be interesting for a lot of people is Kiwisaver. What's the best thing to do actually in the next couple of weeks or couple of months, or how to go about it?
Very, very good question, Vess. I think a very, very topical question amongst especially people like myself, mid to late 20s. People are saying, that was going to be my house deposit, big hit's been taken. What's the best thing to do? Well, I think, lumping people into two categories, especially with those who have had growth fund and experienced some big losses. If you're long-term in your Kiwisaver, meaning more than 5 years, don't change anything, because once you change from growth to conservative, you're actually realizing those losses. So if anyone's seen them, very traditional rudimentary share investing graphs, for the funds, it's always going upwards diagonally over time. But then the second graph, which follows the months changing, is always up and down, like a big wave. So volatile there, but long term, the growth is quite stable. So, very important that if you're long term in your funds, stay in them, weather the storm. You won't regret it long term, because this is how markets work. Big global events impact them. And this isn't the first time it's happened. 92, there was a big flu pandemic and the markets took a hit. So it's something that's, we've seen before in history, and the markets always recover. And just remember that if you keep investing in your Kiwisaver, when the markets go down, you're still buying shares, you're still buying into those funds at a lower price. So you're perhaps getting a discount if you're thinking long term. So this is now, if you continue to invest, is when you're really kind of making that money back. On the other hand, obviously some clients who've made some big losses, who are looking to buy in the next 6 to 12 months, it's a bit unfortunate, because obviously it's very unlikely you're going to recoup those losses in the next 12 months. We always recommend it to our clients who had the pre-approvals, if you're looking to buy soon, get onto conservative, because, we've had the privilege last 10 years in the growth funds to get some really good returns, 8-12%. Some Kiwisavers done much better than that. And now obviously taking some big hits. So it is a bit unfortunate. If you're looking to buy in the next 6 to 12 months, you may have to realize those losses. But it's kind of a bit too little too late. Maybe a bit of a lesson about investing is that, if you're looking to access that money a bit sooner, it's got to be in the conservative fund, because you don't know what's going to happen. the growth is left up to the markets, and they're volatile.
Mm-hmm.
So it's just a bit unfortunate there.
Yeah. Okay, so guys, if there is someone that doesn't know all the conditions of the Kiwisaver, or don't know if they're in a growth or in conservative, just talk to your mortgage broker for a little bit of advice around that, just to make sure that you're making the best decisions with your money, right?
Yes, that's very true, Vess. Always look for some impartial advice.
Yes.
Who knows? Someone who knows what they're talking about, whether it's your banker, your broker, or maybe you've got a friend or family member who's experienced investor, especially around that Kiwisaver stuff. But mortgages, the door's always open with Mortgage HQ, free to call and free to chat. So give us a call.
Thanks, Daniel. Thanks for the time, and I really appreciate your advice. And if there is anything that changes in the next couple of weeks regarding interest rates or mortgages, borrowing conditions, and all that stuff, we're going to do another update for sure.
Yep, for sure, Vess. Always a pleasure. I so thankful I'm finally on the show. So any excuse to get back on, just get me on here. You know where to find me.
Thanks, Dan. Thank you. And talk soon.
Cheers, mate.
Bye-bye.
Okay, see ya.